Today, we're tackling a topic that can feel intimidating for many: investing. Building wealth and securing your financial future is an important goal, but navigating the world of investments can be overwhelming. There's a lot of information out there, and it's easy to fall prey to bad advice or get discouraged by misconceptions. But fear not. By debunking some of the biggest investing myths, we can empower you to make informed decisions and build a strong investment portfolio. Let's break down these myths and set you on the path to financial success. Myth number 1. You need a vault of cash to start investing. This is a pervasive myth that can prevent people from even dipping their toes into the investment pool. You might envision needing a hefty inheritance or a six-figure salary to get started, but that's simply not true. The beauty of the investment landscape in 2024 is the rise of fractional shares and robo-advisors. These innovations allow you to invest with just a small amount of money, often as little as a few dollars. It's all about starting early and building a consistent habit of investing. Think of it like building a muscle. The sooner you start, the stronger it gets over time. Let's say you can set aside just $25 a week. Over a year, that's $1,300. While it might not seem like much with fractional shares, you can invest that $1,300 across a variety of companies, even those with traditionally high share prices. This allows you to participate in the growth of those companies without needing to buy a whole share. Robo-advisors are another great option for beginners. These automated investment platforms ask you a series of questions about your risk tolerance and financial goals, then build a diversified portfolio for you based on your answers. They handle the rebalancing and reinvesting, making it a hands-off approach that's perfect for those who are new to investing or simply don't have the time to actively manage their portfolio. Myth number 2. Investing is just like gambling at the casino. This myth can make some people shy away from investing altogether. There's no doubt that there's an element of risk involved, but investing is fundamentally different from gambling. When you gamble, you're essentially placing a bet on chance, hoping for a lucky outcome. Investing, on the other hand, involves research, analysis, and building a portfolio based on your goals and risk tolerance. You're not just throwing darts in the dark, you're putting your money into assets that have the potential to grow over time, companies you believe in, sectors with strong growth prospects, or real estate that appreciates in value. By doing your research and understanding the underlying factors that influence these assets, you're making calculated decisions, not blind bets. Myth number 3. The stock market is a one-way ticket to upward riches. This myth can lead to unrealistic expectations and disappointment. The stock market is a complex beast, and while there have been historical periods of significant growth, there will inevitably be periods of decline. It's important to understand that the market is cyclical, with ups and downs. The key for investors is to stay invested for the long term and not panic sell during short-term dips. History has shown that the stock market tends to trend upwards over time, but it's not a smooth, uninterrupted climb. Having a long-term perspective helps you weather the inevitable storms and ride out the market fluctuations. Myth number 4. You need to be glued to your investment screen 24/7. Constantly checking your portfolio can be a recipe for disaster. While it's important to monitor your investments periodically and stay informed about the market, obsessing over every tiny movement can lead to emotional decisions. Imagine watching the stock market tick by tick and seeing your portfolio value fluctuate. This can trigger anxiety and a desire to sell your investments at a loss just to avoid further pain. The reality is that the market can be volatile in the short term, but over the long haul, it tends to trend upwards. By checking your portfolio regularly, but not constantly, you can stay informed about your investment's performance without getting caught up in the day-to-day noise. Think of it like a marathon, not a sprint. You wouldn't constantly check your pace every minute of the race, would you? Focus on your long-term goals and trust the strategy. Myth number 5. Putting all your eggs in one basket is a winning strategy. This myth can expose you to unnecessary risk. Diversification is a cornerstone of successful investing. The idea is to spread your investments across different asset classes, such as stocks, bonds, and real estate. This way, if one asset class performs poorly, the others can help balance things out and mitigate the overall risk to your portfolio. Think of it like building a house. You wouldn't want to rely solely on a single flimsy support beam, would you? By diversifying your investments, you're essentially creating a strong foundation for your financial future. There are many different asset classes to choose from, each with its own risk-reward profile. Stocks offer the potential for high growth, but also carry higher risk. Bonds tend to be less volatile, but also offer lower returns. Real estate can provide steady income through rent and potential for appreciation in value. The key is to find the right mix of these asset classes that aligns with your risk tolerance and financial goals. Myth number 6. You need a fancy financial advisor to be successful. Financial advisors can be valuable resources, but they're not mandatory for everyone. There's a wealth of information available online, through libraries, and even on this very channel. By educating yourself about different investment options, understanding basic financial concepts, and developing a solid investment strategy, you can take control of your financial future without necessarily needing a professional advisor. However, there are situations where a financial advisor can be incredibly beneficial. If you have a complex financial situation, a high net worth, or simply lack the time or confidence to manage your own investments, then seeking professional guidance can be a wise decision. A good financial advisor can help you create a personalized investment plan, make informed decisions based on your unique circumstances, and provide ongoing support and guidance. Myth number 7. Past performance is a crystal ball for the future. This myth can lead you down a path of disappointment. Just because a stock or investment performed well in the past doesn't guarantee future success. The market is constantly changing, influenced by a multitude of factors: economic conditions, political events, technological advancements, and even consumer trends. What worked brilliantly in the past might not translate to future gains. Instead of focusing solely on past performance, focus on the company's fundamentals, its future growth prospects, and its overall financial health. Is the company well managed? Does it have a strong competitive advantage? Is it operating in a growing industry? By conducting thorough research and understanding the underlying factors that drive a company's success, you'll be better positioned to make informed investment decisions, even if past performance isn't a perfect predictor of the future. Myth number 8. Hot tips from your uncle or online guru are the golden ticket. This myth can be a recipe for disaster. Don't chase get-rich-quick schemes or blindly follow hot tips from friends, family, or even charismatic online personalities. Remember, if something sounds too good to be true, it probably is. The people peddling these hot tips might have good intentions, but they're likely not qualified financial advisors and may not have your best interests at heart. Instead of relying on hearsay, do your own research. Read financial news, analyze company reports, and educate yourself about different investment strategies. There are plenty of reputable resources available to help you make informed decisions. By taking control of your own investment education, you'll be less susceptible to falling prey to unreliable advice and more likely to achieve your financial goals. Myth number 9. Fees don't matter, they're just a drop in the bucket. This myth can be a costly one. Investment fees, even seemingly small ones, can eat into your returns over time. Remember, the goal is to grow your wealth and every dollar you pay in fees is a dollar less you have working for you. In 2024, with the rise of low-cost index funds and commission-free trading platforms, there's no excuse for paying exorbitant fees. Shop around for investment options with low expense ratios and minimal fees. A few percentage points might not seem like much up front, but over the course of decades, they can significantly impact your overall returns. By being mindful of fees and choosing cost-effective investment options, you're essentially putting more money back in your pocket and allowing your investments to grow to their full potential. Myth number 10. Investing is like rocket science. Only geniuses can do it. This myth can be intimidating and discourage people from even trying. The truth is, investing isn't rocket science. There's definitely a learning curve, but with some basic knowledge and the right resources, anyone can become a capable investor. There are countless online courses, educational platforms, and even books written in a clear, accessible way. Don't be afraid to start with the fundamentals, understanding basic financial terms, different investment vehicles, and how the market works. The more you learn, the more confident you'll become in making sound investment decisions. Remember, successful investors come from all walks of life and educational backgrounds. What matters most is your commitment to learning, your willingness to take calculated risks, and your ability to stay disciplined with your investment strategy. Beyond the myths, building a strong investment foundation. Now that we've debunked these 10 common myths, let's explore some key principles for building a strong investment foundation. Define your goals. What are you investing for? Retirement, a child's education, a dream vacation? Knowing your goals will help you determine your investment timeline and risk tolerance. Develop a strategy. There's no one-size-fits-all approach. Choose an investment strategy that aligns with your goals and risk tolerance. Do you prefer a passive approach with low-cost index funds or a more active approach with individual stock picking? Start early and invest regularly. The power of compound interest is a beautiful thing. The sooner you start and the more consistently you invest, the more your money has the potential to grow over time. Stay disciplined. Don't let emotions dictate your investment decisions. Stick to your strategy and avoid panic selling during market downturns. Rebalance. Periodically. Over time, your asset allocation can get out of whack. Rebalancing your portfolio helps ensure it remains aligned with your goals and risk tolerance. Investing can be a powerful tool to build wealth and secure your financial future. By debunking these common myths and developing a sound investment strategy, you'll be well on your way to achieving your financial goals. Remember, investing is a marathon, not a sprint. Stay patient, stay informed, and don't be afraid to seek professional guidance if needed. With dedication and a little bit of knowledge, you can become a confident and successful investor. If you enjoyed this video, leave a thumbs up and subscribe for more content on personal finance and investing. Also, let me know in the comments below what other investing questions you have. Thanks for watching. By following these tips and debunking the myths that can hold you back, you'll be well on your way to a bright financial future. Remember, knowledge is power, and when it comes to investing, taking control of your education is the first step towards success.